So shape management is really about understanding the mathematical drivers of bonds and understanding what a total return of a bond will be in different interest rate environments. And we call that a shape. It's sort of the nature of the total return across a spectrum of interest rates. And what we aim to do is combine shapes to deliver more of a rate agnostic total return to our investors at the end of the day.
Hello, you're watching Proactive. I'm joined by Sean Dranfield. He's the CEO of Performance Trust Asset Management. Sean, very good to meet you. We're chatting about the Performance Trust Total Returned Bond UCITS ETF. Bit of a mouthful there. Tell us more about the ETF and what its objectives are.
Absolutely. So it's a bond fund, an active bond fund that invests across the entirety of the U.S. bond market. So different sectors in the U.S., with the view to try to deliver a consistent sort of steady Eddie total return to our investors.
You said an active fund, Sean, and usually ETFs are passive investments. Why active in the bond market?
So I think there's actually quite compelling evidence to suggest that active management actually works in the bond market. And I think that's consistently proven over time. So for example, if I think about our flagship fund in the US, it's been around for 15 years, and it's very consistently done a good job of delivering outperformance net of fees that you would typically get on a passive ETF.
Tell us why US bonds, why would you invest in them?
So we have a slightly different take on sort of thinking about the bond market. So we would take the view that really no one can top-down predict or make a case for why one asset class over another, because top-down predicting, in our view, is a fool's errand. I think the one thing that the US bond market offers for a European or a British investor is it has a large element of what we would call defense. So these are bonds that could help you if rates happen to go up. And when you think about the typical bond in the UK or Europe, it tends to be a highly rate-sensitive bond. So when interest rates go up, those bonds will underperform. So we can provide sort of a complement to that typical sort of bond reaction in a rates-up environment by virtue of how we think about bonds and the bonds that we invest in.
But you also have offensive sectors in the bond market. So tell us the difference between the offensive and defensive sectors, and perhaps give us a couple of examples.
Absolutely. So we take the view that no one can predict interest rates. And in fact, if you look at the US market, if I look at the last 20 years, I'd say Wall Street is typically directionally wrong as it relates to predicting interest rates. So an offensive bond for us is a bond that would help you if rates go down. A defensive bond is a bond that'll help you if rates go up. So what we aim to do is we aim to combine those two sorts of bonds to deliver more of a consistent total return that forms a return profile that's agnostic to interest rates, because our view is no one can predict interest rates.
So what would be a defensive sector for bonds?
Yeah, so this, I'll try not to get too technical, but there are certain bond structures that offer total returns or prices that really don't move up or down as a typical interest rate, as a typical bond would. So if I think about a gilt, for example, the structure of a gilt is typically a bunch of coupon payments and then a principal payment at the end of the bond's life. When rates go up or down with that sort of bond structure, that bond's price will be highly sensitive to interest rates. So one of the structures that we like are interest-only bonds, where the bond structure is only delivering a cash flow that's simply a coupon. So if you think about a coupon, you're gonna get the same cash flow irrespective of whether or not rates go up or down, and therefore the price of that bond isn't sensitive to interest rate movements. So that would be a typical sort of defensive bond. It could be a shorter bond as well, where the price of the bond really isn't that exposed to interest rate movements.
And an offensive bond?
An offensive bond would be a bond that's much more rate sensitive. So in our case today, two sectors that we quite like is we like sort of 20-year treasuries. There's some mathematical reasons for that, but those bonds should do very well in a rates down environment. The other sector we quite like in the US market right now are taxable municipal bonds. And that's because their prices are slightly more attractive than other typical offensive bonds like an investment grade corporate or another treasury, for example.
Now, Sean, Performance Trust takes a different approach. You use shape management. Could you explain what shape management means?
I can. So perhaps to do it best, I want to take a sort of step back and think about a bond versus an equity. So when your investors think about bonds and equities, they might think, well, I get a total return from a stock, a total return from a bond. I would make the argument that the way the two securities operate are fundamentally different. So if I think about Google as an example, I might read research that attempts to predict Google's price or its dividend, but I don't know. And that's the total return of that stock will be the combination of the two. With a bond, unlike a stock, the coupon is a contractual obligation, so it's a known. The price of a bond, I may not know what interest rates will do, but the price of a bond is knowable. So if rates go up or down, I can calculate to the 10th decimal place what a price will be. So shape management is really about understanding the mathematical drivers of bonds and understanding what a total return of a bond will be in different interest rate environments. And we call that a shape. It's sort of the nature of the total return across a spectrum of interest rates. And what we aim to do is combine shapes to deliver more of a rate agnostic total return to our investors at the end of the day. So our products tend to be much less rate sensitive or credit sensitive than a typical bond fund would be. And I would argue that most people, that's what they try to lever to generate sort of outperformance. Our secret sauce, as it were, is this methodology that dives deeper into the granular math of bonds.
And how has that secret sauce helped your performance, Sean?
So what it's done is, because it's sort of this objective, mathematical, repeatable process, it's delivered over time very, very consistent outcomes. So if I look at our performance versus our competitors or the index on a rolling 5, 7, and 10-year basis, we've actually outperformed the index and our competitors 100% of the time. Typically 150 or 1.5% outperformance net of even fees. On a 1 and 3 year basis, we tend to outperform 80 to 85% of the time. And I can tell you the only markets we'll underperform in is if rates scream down in a very short period of time. And that's because our competitors in the index really only buy rate sensitive bonds. So all of those bonds will do well if rates scream down. Even in that environment, we'll have a combination of defense and offense, so we'll tend to underperform in that environment, but our clients will get a very nice total return because when rates go down, the prices of bonds go up. So that's the sort of environment we'll underperform in, but over time, we deliver very consistent, repeatable, sort of conservative returns.
Could you give us an example of a few of your top holdings, Sean?
Yeah, so I talked about interest-only bonds before, so one sector we quite like are commercial mortgage-backed securities. So these are bonds that are issued by the agencies in the US. So as I mentioned earlier, they're interest-only bonds. So these are 10-year bonds. I would say in a rates up, rates down, rates sideways environment, they tend to have annualized returns of 6-7%. For a bond manager, that's a very attractive total return, particularly if you have a bond that's not sensitive to rates or sensitive to credit. So that would be one example of a defensive sector that we quite like. We also really like very short asset-backed securities and CLOs. Similarly, because their total returns are in this sort of 6%-ish range, rates up, rates down, rates sideways, and they're very strong credits as well. And I mentioned earlier on the offensive side, taxable munis and the 20-year treasury is another portion of the yield curve we quite like offensively.
Okay, so Sean, give us the investment case for the Performance Trust Total Return Bond UCITS ETF.
So I think the investment case is really around this secret sauce called shape management that I think will ultimately deliver clients a less rate-sensitive outcome than a traditional bond fund. And what I find our clients doing in Europe or in the UK is really combining us with a more traditional bond fund. And by virtue of doing that, you're going to get this consistent outcome from us. And combined, it'll create this smoother return profile that I think is really helpful to investors, particularly those that invest in a bond fund, who I think typically want sort of a more predictable outcome than maybe their allocation to equities might be.
Well, Sean, thank you very much for coming into the studio today to share all that. I hope you'll stop by next time you're in London.
Absolutely. Thanks, Stephen. Very much appreciate your time.
Sean Dranfield, he's the CEO of the Performance Trust Asset Management.